What's up, everybody? Welcome back. Hope you guys are having a great day. So if you're joining us for the first time, welcome. It's great to have you. I am currently reading a book. It's called What Would the Rockefellers Do? How the Wealthy Get and Stay That Way, and How You Can Too, by Garrett Gunderson. I'm reading the book chapter by chapter and kind of going over what I am getting from the book. This is a book that I am reading for myself as well. I am a life insurance agent, and this book is talking about a product called cash flow insurance. So in the insurance market, two of the most popular cash flow insurance options are whole life insurance and indexed universal life insurance. These two policies not only provide you a death benefit, meaning if when you pass away, your significant other, your spouse, your kids will receive a lump sum of whatever it is, 300,000, 500,000, a million. They will receive that upon your death. These policies also build cash value, right? Whole life policies are more of a fixed rate. They're not invested in anything like the stock market. So whole life policies, the amount of money you put in each month, if you're paying $200 a month for this policy, part of that is put into a fund that is accessible to you. It is your money. It is invested, for lack of a better word, but it grows at a specific fixed rate depending on the company you're with. The other option, the indexed universal life policy, is more geared towards the stock market. It is not as volatile as the stock market that you see right now that's doing its thing. It does get invested in stock markets, but it is invested wisely, right? So that policy, indexed universal life policy, also builds cash value. It just does so a little bit differently, but they both build cash value, and that's what this book is about. Chapter 3 is the chapter we're on, and it's just called What Cash Flow Insurance Really Means. I kind of just explained it to you in this video. I did it in the last video as well. Essentially, what this is saying is you have a policy that you own. It's not a policy given to you from your job. You own this policy. It is X amount per month that you can put into it. You can put additional money into indexed universal life policy. So if you're paying for an IUL, if you're paying $200 a month into that policy and it's growing, right? You get your tax return next year. Let's say you get some money back. You can throw an additional $1,000 in there, and that money that you put in will also grow cash value. So you're building it kind of like a bank, right? But you own the money. You own everything in there. Nobody will tell you anything on how to use it. That's one of the huge benefits of having these types of policies, both of them, not just IUL, whole life as well, builds its cash value as well. So 3 key points that Garrett points out in this chapter about cash flow insurance is: 1, it safeguards your wealth, meaning it can never be taken away from you. If you get sued, if something happens, like that money will never go to anybody but you, right? It safeguards your wealth. 2, it helps you grow your money and increase your cash flow. We just talked about that. It continues to grow every month and helps you enjoy your money today and tomorrow, right? And what that means, if you watched the last video, if you didn't, I'll just kind of reiterate it here, is this money can be borrowed. Your cash value, let's say 10 years from now, you have $40,000 in there. You can take that money, IUL, whole life, no taxes, not taxed, and then you take it $20,000 to put money down on a car, maybe $20,000. Now, you don't have to pay it back. You can pay it back how you want to pay it back. We recommend you pay it back so you can put it back in and it can grow and you can use it 10 years later. But it is your money, kind of like that commercial, it's your money, use it when you need it, right? J.G. Wentworth, I believe, is the commercial. But it's your money, it's there. You can take it when you need it, IUL or whole life. the money builds, it keeps building, and you can take it when you need it, if you need it. Hopefully you don't need it for anything, but you never know. The last thing I will tell you is he also talks about financial institutes. They have an agenda, right? They want our money, right? They want our money on a regular basis. They want to hold onto our money for as long as possible. When it comes time to go get our money, they want us to pay it back as slowly as possible, right? Because of the interest and because of everything that they're getting when you're paying them back. A loan you take from them, right? Because you're taking the money, a loan from them, they're going to charge you interest. They're going to charge you extra money. They're going to get their money back and then some. Whereas in an IUL or a whole life policy, when you take the money out, it's not taxed. You don't pay back interest. You're paying back what you took out, right? And another great thing about an IUL, this is an option for some companies. You can have, let's say you have a death benefit of $300,000 and you have an IUL, which means you have cash value. The cash value, after a certain amount of years, will then start getting added to your death benefit. So let's say 20 years down the line, you have this IUL and it's worth cash value $80,000. And you have a $300,000 death benefit. It is now worth $380,000. So if you don't take the money out, the $80,000, you pass away at that point. Your death benefit is $380,000, not $300,000. So that grows along with the cash value. All right, make sense? IUL, for me, if you're younger and can afford it, an IUL is the way to go. Whole life is great too, but an IUL, in my opinion, because it doesn't grow at a fixed rate. I know you may think, oh, that's going to be risky. I mean, a little bit, but in the long run, if you're younger, it will grow and it will keep growing at a better rate once the stock market kind of recorrects and does its thing. Because mostly stock market goes up, goes down a little bit, up, down a little bit. There are rocky periods, but your money will grow in the IUL. So anyway, that's the chapter. And the next chapter is chapter 4. And it is, so this was chapter 4. I believe. Yeah, sorry, this is chapter 4, not 3. This is chapter 4. Chapter 5 is finding money to fund your bank. Chapter 5. So sorry, this was chapter 4. Chapter 5 is next. So look forward to that. Thanks for watching. Have a great rest of your day.